You checked your bank account this morning. The number sitting there feels smaller than it should. You've been working, earning, doing everything you're supposed to do, but somehow the math doesn't add up. Money comes in, money goes out, and somewhere in between you lose track of where it actually went. Here's what nobody tells you. The reason you feel confused about money isn't because you're bad with it. It's because the entire financial system runs on concepts that sound simple, but hide layers of complexity designed to keep you guessing. Let's start with taxes because that's where the confusion begins for most people. You earn $2,000. Your bank account shows 1,456. Where did the rest go? Federal income tax took a chunk. State tax grabbed another piece. Social Security carved out its portion. Medicare helped itself to some more. This isn't theft, even though it feels that way. It's the price tag attached to living in a functioning society. Roads get paved, schools stay open, emergency services show up when you call. The military does whatever it is they do. All of that costs money, and that money comes from you. But here's where it gets weird. The government already knows exactly how much you owe. They have all your information, all your numbers, everything they need to calculate your tax bill down to the penny. Yet they make you figure it out yourself. You have to guess what you owe, file paperwork proving your guess, and if you guess wrong, you face penalties. Some people pay quarterly, others pay annually. A few don't pay at all and end up with federal agents knocking on their door. The system feels deliberately confusing because, well, it kind of is. Now let's talk about banks because this is where things get really interesting. You walk into a bank, hand over your cash, watch them count it, and they tell you it's safe in your account. You leave thinking your money is sitting in a vault somewhere, probably next to other people's money, all of it guarded and secure. That's not what happens. The moment you deposit $1,000, the bank takes 900 of it and loans it to someone else. Maybe that person wants to start a business. Maybe they're buying a car. Doesn't matter. Your money is gone, out the door, working for someone else. This system is called fractional reserve banking. Banks only keep a fraction of deposits on hand because they're betting that not everyone will want their money at the same time. It's a gamble that usually works until it doesn't. In 2008, people panicked and rushed to withdraw everything. Banks didn't have the cash. The entire system nearly collapsed. But in normal times, this setup works smoothly. Banks make money by charging borrowers higher interest rates than they pay depositors. You're the supply. Borrowers are the demand. The bank is just the middleman taking a cut. So why do you even use banks? Convenience mostly. Carrying cash everywhere is risky and annoying. Banks also pay you interest for keeping money with them, though it's usually a tiny amount. More importantly, in the United States, deposits up to $250,000 per person are federally insured. If the bank fails, you still get your money back. That's a pretty good deal. Which brings us to interest, and this is where your financial future actually gets decided. Interest is rent. When you borrow money, you pay rent to use someone else's cash. When you save or invest, you collect rent from others using yours. There are two types, and understanding the difference matters more than almost anything else about money. Simple interest is straightforward. Borrow $1,000 at 10% simple interest, you owe $100. Done. Compound interest is different. It's interest on interest. Your debt or your wealth doesn't just grow, it accelerates. Miss a credit card payment at 20% interest, and suddenly you're paying interest on the interest you already owed. That $12 lunch can balloon into a $50 mistake faster than you'd think. But flip that around. Invest $100 at 7% compound interest annually, and it doubles to $200, then $400, then $800. Give it enough time and you're looking at serious wealth built from modest beginnings. This is the invisible engine running beneath everything. Loans turn small mistakes into financial disasters through compound interest working against you. Investments turn small contributions into fortunes through compound interest working for you. The question isn't whether interest will affect your life. It's whether you'll be paying it or collecting it. And that difference determines almost everything about your financial future. But there's something else at play here. Something that's quietly eroding the value of every dollar you own right now. And most people don't even notice it happening. Inflation is that force. It's the silent thief that makes every dollar in your pocket worth a little less each year. You don't see it happening. There's no announcement, no alarm bells. One day you notice that bag of chips costs more and holds less. Gas prices creep upward, rent increases, Your paycheck stays the same, but somehow it doesn't stretch as far as it used to. That's inflation doing its work. Here's what actually causes it. Sometimes too much money floods the economy. Everyone has cash to spend, and they all want the same products. Demand skyrockets. Supply can't keep up. Prices rise because sellers realize they can charge more and people will still pay. Imagine 2,000 buyers competing for 1,000 televisions. The price isn't staying at $500. It's jumping to $800 because the seller knows someone will pay it. Other times, it's supply chain disruptions. Manufacturing costs increase, shipping gets expensive, raw materials become scarce. Businesses pass those costs directly to you. Sometimes inflation happens because people expect it to happen. If everyone believes prices will rise next month, they spend more today to beat the increase. That surge in spending pushes prices up faster. It's a prophecy that fulfills itself. A little inflation is normal. 2% annually, that's fine. The economy can handle it. But when inflation spikes, savings lose value rapidly. Your emergency fund sitting in a regular savings account is actually shrinking in purchasing power every single day. Wages rarely keep pace with sudden inflation spikes, so you're effectively getting a pay cut without anyone telling you. Governments fight inflation by raising interest rates. Higher rates mean borrowing becomes more expensive. People spend less because loans cost more. Demand cools off. Prices stabilize or even drop. It's economic braking, and it works, but it's painful in the short term, which leads to recessions. A recession happens when the economy shrinks for at least 2 consecutive quarters. 6 months of decline. Jobs disappear, companies cut expenses, consumer spending drops because people hoard money for essentials instead of luxuries. Stock markets tumble. Suddenly that stable job doesn't feel so stable anymore. What triggers a recession? Could be those high interest rates choking off growth. Could be a global crisis like a pandemic or war. Could be something as random as a container ship blocking a major trade route. Sometimes it's just the natural economic cycle playing out. Boom periods can't last forever. Expansion reaches a peak, then contraction begins. The economy resets itself, painfully. Recessions aren't permanent. Governments respond by lowering interest rates again, injecting stimulus money into the economy, hoping people start spending. Eventually, confidence returns. Businesses rebuild. Hiring resumes, growth restarts. But the scars remain for everyone who lost a job or watched their savings evaporate. Through all of this, there's one number quietly tracking your financial trustworthiness: your credit score. It's a 3-digit figure ranging from 300 to 850. Lenders use it to decide whether you're worth the risk. Below 580, you're practically radioactive to banks. Above 750, doors open easily. Most people hover somewhere between 640 and 790. How is it calculated? Payment history carries the most weight. Do you pay bills on time consistently? That's the foundation. Credit utilization matters too. If you're maxing out credit cards, that's a red flag. Using 30% or less of your available credit looks responsible. The age of your accounts factors in. Older accounts demonstrate stability. Credit mix helps as well. Having a combination of credit cards, loans, and a mortgage shows you can handle different types of debt. New credit inquiries can hurt temporarily because too many applications suggest desperation. Improving your score is straightforward but requires discipline. Pay everything before the due date. Keep credit card balances low. Don't close old accounts even if you're not using them. Avoid applying for multiple credit lines in a short period. The score will climb steadily if you follow these rules. But here's the strange part. You can have zero debt and still have a terrible credit score if you've never borrowed money. The system rewards controlled borrowing, not abstinence. It's designed to measure how well you manage debt, not how well you avoid it. Learn the rules, and you can make the system work for you instead of against you. Everything about modern money comes down to understanding these invisible forces. Interest compounds your wealth or your debt depending on which side you're on. Inflation erodes value while you sleep. Recessions reset the economy whether you're ready or not. Credit scores determine access to opportunities based on past behavior. None of this is accidental. These are the mechanisms that separate people who build wealth from people who wonder where their money went. The difference isn't luck, it's knowing how the game actually works and playing accordingly. Now you know what's really happening beneath the surface. The financial system isn't designed to be mysterious. It just looks that way when nobody bothers explaining it properly. Every paycheck that seems too small, every bank balance that doesn't make sense, every interest charge that catches you off guard, it all follows predictable rules. You just weren't taught them. Now you understand how money actually moves, how it grows or shrinks, and why the numbers sometimes feel rigged against you. That knowledge changes everything because you can't win a game when you don't know the rules.